And our recording is started. Welcome to this multi-charts webinar event, everyone. A few technical items first. Attendees can access the audio portion of this event either by using the VoIP connection or by teleconference. The audio and volume controls are found under the Communication tab at the top of the event window. Simply select Integrated Voice Conference and then Join Conference. We are recording today's webinar event, and the recording will be made available tomorrow after checking it for technical difficulties. We will have a Q&A period at the end of this event. Questions may be submitted via the chat function found on the right side of the screen. Multicharts is committed to providing traders with information that can help improve results, and we believe that a better informed trader is indeed a better trader. Of course, there are many different trading styles, methods, and systems, and we're trying to provide information that can help you make more informed decisions and be a better trader. The opinions expressed by the presenter do not necessarily reflect the opinions of Multicharts. We suggest all traders perform their own due diligence. Now, our presenter today is Alex Christoph. I will be brief in my introduction in order to get right to our presentation. Alex is the founder of EdgeSense.net, the company which focuses on consulting in automated trading. He has participated in a number of complex infrastructural projects which involve IT solutions, market research, and trading systems development and evaluation. Alex is known for his uncommon views on markets and trading, allowing consistent profits, and his proprietary methods of robustness evaluation have saved time and money for many. He's also the author of a number of fully automated trading systems. Today's topic is working with exotic chart types and how to do proper backtesting with them. And with that said, I'm going to turn things over to Alex. Alex, are you there?
Yes, I'm here. Thank you, Jeff.
Okay, great.
Good afternoon, everyone. As my company focuses mostly on quant research and development, I always focus on those features of the software that I use, and in particular multicharts, and I heavily use multicharts for research and development, which make it outstanding. And of course, multicharts is a very, very useful tool for research and development of trading systems because it has a very good and very reliable backtesting engine. I would say that among retail software on the market, it has the best backtesting engine, and which produces the most reliable results. However, one should make backtests carefully and always understanding what he is doing when doing backtests, not to say about live trading. When you do backtests over time-based bars, that is regular type of bars, normally it has no problem. Of course, there are some tricky issues that are not the topic of today's discussion, but if you simply create a strategy that buys or sells at the closing price of the bar or at the opening price of the new bar, then you are more or less safe with your backtesting and you can trust the results of the backtest. However, there are certain types of charts, we call them exotic charts, which require absolutely different approach with doing backtests, because if plain backtest techniques are applied to them, they can produce very ridiculous results, and unfortunately these ridiculous results are overly good looking. So I will try to explain how to properly use these exotic charts so that you be absolutely sure in the results of your backtest. We will discuss 4 types of exotic charts today. They are point and figure, Renko, Heiken Ashi, and line break. All of them are seldom implemented in trading software, and maybe this is one of the reasons why many traders believe that there is some intrinsic edge in the very form of the chart. Perhaps this idea comes from the very special look of each chart because it is quite unlike the regular bars that we are all accustomed to see. We will start with point and figure chart. To create a point and figure chart in multi-chart, you should choose the point and figure in the instrument settings and choose first the chart type, the box size, this is the value 2.5, and the reversal. Let's explain what this all means. Here's the typical look of a point and figure chart. We start plotting from, say, 1,300. The price 1,300 points. And we continue to plot crosses as long as price is going up. We continue plotting we continue to add each box as soon as price travels 2.5 points to our favor, to our direction, that is currently upwards. So crosses are for upwards direction and nodes are for downwards direction. We continue to do that until we see a reversal. And the reversal is the very value that we set in the instrument properties. In this case, price has to go to the opposite side, that means down, 3 times more than the value of a single cross or knot. So a reversal happens in case price goes to the opposite side 3 times more than 2.5 points in our example. This is why point and figure charts are mostly mentioned in terms of trend detection or trend following or trading major moves or main moves or anything like that, because point and figure chart eliminates minor moves that are very often called noise, market noise, and presents only in a very clear form only major moves. And a classical approach for using point and figure charts is simply to buy when one sees a new series of crosses and to sell with a new series of nodes. Simply because the idea behind this charting technique is that if movement started to one direction, it will persist. So let's try to apply this very basic, very primitive strategy, and we will see what will happen if we apply it plainly to point and figure charts. We will see that the main issue, we cannot do backtesting without some special assumptions. Okay, we will apply a custom strategy, a very basic one. We add a custom strategy long entry, and we choose the long entry condition as close is less than open. This means normally a bar which has a close below the open, or a red candlestick, and then we need to buy at the opening price of the next bar. So as soon as we see a bar which pointed downwards and it is ended, we buy. And we add a short entry, a custom short entry, with exactly the opposite condition. So this will be a reversal strategy, always in the market, but of course, as we are still doing some tests, it's okay. Okay, let's apply both conditions, and now we have a ready strategy. So this is the performance of this strategy in the form that I've just shown. The good question is whether it is a holy grail. I believe everyone knows that the answer is no. The question is why? In this case, the answer is more or less simple, but it needs some attention and some more closer look at the point and figure charts to understand why we received so ridiculously great results. So let's zoom in and see how the point and figure chart looks like actually. The backtesting engine of multi-charts considers each sequence of nodes or crosses as a single solid bar. In other words, you have only visual representation of crosses or nodes on screen, but from the backtester's point of view, this is simply a bar with its closing price equal to its low and with its opening price equal to its high. Therefore, as soon as the backtester enumerates the condition to buy at the beginning of the next bar, if this current bar closes down, of course the backtester should place the long trade at the open of the next bar. But in reality, we cannot place trades at this price because we need at least three boxes on this level. To trigger a reversal. So we have always an error equal to 3 boxes size. We added this value to each trade. This is why we don't have losing trades, as you can see on this picture. All trades are profitable, and of course these trades simply couldn't exist in reality. So, does it mean that we cannot work with point and figure charts? Does it mean that we can make reliable tests on this type of chart? Of course not. Of course we can. In this particular case, the solution is rather simple. We only have to subtract this error value of 3 boxes from each trade. We can make it using, for example, slippage settings. Slippage or commission, in this case, it doesn't matter because we simply, both options allow us to subtract a fixed value from each trade. So we put here 3 boxes of 2.5 points multiplied by the point value. Actually, you cannot do calculations in this field. You simply put all this formula here for convenience, for clear understanding. But anyway, you should multiply all these 3 figures and subtract this value from each trade result. So, what we're going to see now, it is far more realistic. This is one of the most widespread mistake that is done by many traders who start to learn about point and figure charts and other exotic chart types, because they simply apply the conventional backtesting techniques to these charts, and they get excellent performance, hypothetical performance, and then if they try to put it to live trading, they suffer very severe losses. Now, I hope you can see the reason why. I would like to ask everyone if anyone has questions, so please ask.
Alex, at this point, we have not gotten any questions, but I would like to ask you, so what you're saying is that there is an inherent problem with point and figure that you have to account for that isn't accounted for with the typical way that backtesting is done. Is that correct?
Well, in this case of working with point and figure charts, it can be catered for simply adding this fixed slippage value. This is more or less easy because we have an error which is constant on each bar. If you have a more complex strategy where point and figure is involved, of course you should do something else. But I was trying simply to understand the reason, the source of errors of this type, that you simply cannot enter or exit the market at the price suggested by the backtesting engine. So you have to always make some correction. Is it clear?
Yes, it is. Yes, it is. Thank you. And we did just have one question, and somebody said this is very interesting and wanted to know if the slide presentation also would be available after the presentation. Obviously, we are going to make the recording of the presentation available tomorrow, and so you'll have access to the slides at that time. And obviously, if you want to contact Alex about anything in particular, we'll give his contact information at the end of the presentation. And I don't see any other questions at this point, Alex, so I'm going to take that as a sign that either you're explaining yourself extremely well, or people just aren't sure how to phrase their questions.
Okay. So we will proceed with Renko charts. So what is the Renko? As far as I remember, it's a Japanese word. I do not remember the exact meaning, but in its essence, it's something like an evolvement of point and figure in time. So, in case of point and figure, we plot each cross on top of the previous one, and we plot each node below the previous one. Thus, we form columns. In case of Renko bars, we plot each block, each box, with a fixed shift to the right. So instead of columns, we have very nicely looking diagonal lines. To plot a Renko chart, we also have settings very similar to those of point and figure, if you consider them thoroughly. We also have a box size. In this case, it's also 2.5 points. And I'm sorry. And we can choose the resolution of regular bars on which the Renko chart is based. In this case, we choose a 1 minute resolution as the lowest one. At least I don't have continuous contract historical data for several years in TEAT data, but 1 minute is well enough for this test, as long as we have such a significant box value of 2.5 points. This is a typical look of Renko chart. And I know that when a new trader observes this chart for the first time, it seems obvious to him how to trade it, because it consists of trends, everywhere trends. To explain once again how it is constructed. For example, if we have a price traveling below 2 boxes from the previous high, we start a series of descending boxes. And as soon as we have a reversal condition, and in our condition it's simply the price going up 2 boxes above, then we start the new series of ascending boxes. I'm sorry, here is a mistake here. It is ascending, of course. And we continue to plot these ascending boxes or ascending blocks until we see a new reversal. So the idea is very similar to that of point and figure. The difference is that point and figure allows us to adjust the number of boxes or blocks required for a new reversal, and with Renko it is always 1. If you open any book discussing the Renko charts, you will find that they are proposed to use for trend identification. And again, one of the most primitive, most essential, most basic trading techniques of them is supposed to be buying with a new series of upcoming blocks and sell with a new series of descending blocks. Looks more or less obvious. So we have a very essential strategy again, with the closing price greater than open. Then we go long, and if we see a closing price less than open, then we go short. And again, we have a cold period in this case. I suppose now everyone wants an explanation why we have this fantastically looking performance charts. Of course, this is not a holy grail either, but in this case, it's just a bit slightly different from the issue with point and figure. So let's have a closer look at what happens with Renko charts. We see that in case of, for example, let me mark it. In case of this trade, we have a correct entry. So as soon as we have a new block down, we enter the market. But in this case, this is not so. Formally, at this place, the entry is taken at correct point. But here, it should have been taken 1 block higher, because after the closing of this bar, it is impossible to enter at the opening of this one, because we know that this bar, this downward bar, closed only at the moment of its closing. I understand that maybe I'm putting this in a bit confusing way. So the point is that unlike regular bars, the closing price of the Renko bar, or the Renko block, always coincides with the opening price of the new one. Always. and in case of two adjacent blocks pointing to opposite directions, this is not the case. So when the price was there, we in fact should go long from this point, from this price. And the backtesting engine again tried to enter the market at a price that it couldn't enter at this time. So, unlike point and figure, we have an issue only in certain cases. And in fact, these cases are when we have a series of just one block to any side. If we have more than one block, then the entries are correct. So we cannot make a workaround with Renko chart like we did with point and figure, because we cannot subtract any fixed value from the value of each trade. So what to do in this case? Of course, we can create a workaround for that. And this is because multi-chart supports working with multiple data streams. This will allow us to use Renko bars for generating signals and regular bars for making actual entries and exits to perform a reliable backtest. So we will load the regular 1 minute bars for the better resolution of our backtest. And we will place our strategy over the second data stream, which will serve as simply a signal provider for our actual backtest. So this is the first data stream. We need to load the first data stream first, always. Then we add the Renko bars, and note how the Renko bars in fact are distributed in time. This is more or less obvious because, for example, if we have a quick movement, then we have many Renko bars very close to each other, and if market is more or less still, then the distance in time between Renko bars is greater. And by the way, this is one of the points that can be exploited in actual profitable trading systems. But this is not what we're discussing right now. So we now apply a custom strategy, and the only difference is that we use the data to keyword. So if we simply write close, this means the closing price of the first data stream bar. And if we use data to, then this means the closing price of the second data stream. In our case, this is the closing price of a Renko chart. So if the closing price of the Renko chart is higher than the opening price of the Renko chart, then we go long. And the opposite with shorts. So now we have a picture of how trades actually distributed in time. And we can compare now the results. So again, where we had a holy grail, now we see a very realistic and not so pleasant picture. Again, I would like to interrupt myself for a brief question session if there are any.
At this point, Alex, nobody's asking questions, but I'm fascinated by the way that the performance report changes so dramatically. And clearly clearly, this is the more realistic picture that you're showing now than the one that we saw a moment ago.
Of course. And one of my friends called me once a mythbuster in trading. So, okay, if we don't have any more questions, then we proceed with myth busting. And the next exotic chart type is Heiken Ashi or Heiken Ashi. So, I don't know how to pronounce it correctly. It is a very special bar type. And this bar is built from the reference points of the regular bars. Reference points are open, high, low, and close. And you see that neither of these values are equal to just any value of the original, or any reference value of the original bar. So HA means Heiken Ashi. So the close is simply average price. The opening price is again an average. And high and low are maximum and minimum between three values. So this is a very special bar. This is how it looks like mostly. And of course this chart type again produces a very impressive picture, especially when it is painted with blue or red and green. And from the first sight, it looks like, oh, we have now a solution for identifying trends, because everyone loves trends. And thinks that if the trend exists, then he can make a profit out of that. So Heiken Ashi is considered to be one of the tools for better visual representation of trend conditions. Yes, this chart is indeed really smooth, and it's clear why, because of the formulas according to which it is constructed. And again, let me repeat that the fact is that neither of these reference points correspond to those of the original regular bar is very dangerous, in fact, for any quantitative trading, and especially for backtesting. What would happen if we apply our test strategy to Heiken Ashi chart? Yes, no wonder we again have a holy grail, the third one during this evening. Now let's see what will happen if we do the backtest correctly. Again, we have two data streams. I won't repeat how to do a picture like this. And the second data stream is Heiken Ashi, which will generate trading signals, and the upper chart is 30 minutes chart on which the Heiken Ashi chart was based. Then we again apply a strategy which uses data 2, a closing and opening price of data 2 to generate signals. Now we see how it looks like. By the way, in my opinion, one of the greatest advantages of multi-charts is the ability to very easily and quickly observe all the trades, how they actually was done throughout the history. And this is one of the essential parts of all the research and development process, because when you generated a new trading strategy, and especially in case it produces good results, this is a must to observe visually with your own eyes where exactly the entries and exits were taken, and if these points correspond to what was in your mind. Okay, now we have again a realistic picture. Suppose there are still no questions with Heiken Ashi either, because...
Actually, Alex, we have a couple of questions.
Oh, really?
Yes.
I'm happy to answer.
The first one is someone just asked if you could please repeat how to plot second data.
How to plot second data. I will try to find the proper slide now. It's somewhere. No, not here. So, first of all, we need to plot the regular bars, because if we plot the, in this case, Renko bars first, then we won't be able to do a backtest on the regular bars, because multi-threads performs backtest only on the first data stream, that is data 1. So we now have data 1 data stream that is simply regular 1 meter chart. Then we press F5, functional key F5, and it allows us to add a new symbol to the same chart. You can add an arbitrary symbol. You can add, for example, any future. For example, 6E to the ES chart. You can add gold price or Dow Jones or euro currency or anything. But in this case, we add the same instrument, but charted in form of Renko or Heiken Ashi or line break or anything. And this is all. After that, you can apply any strategy that includes word data 2 in its clauses, and it will work over second data stream, but will perform actual enters and exits over the main data stream, that is always data 1. In our case, it's 1 minute chart. Or in case of Heiken Ashi, we have the second data stream here. We first created the 30-meter chart, then we pressed F5, and we added the second data stream with the same instrument, yes, but in form of Heiken Ashi chart. So this is done very straightforward.
And obviously, as with most things in multi-charts, there are other ways that you can add a second data stream. If you wanted to, you could right-click on a chart, select Insert Instrument, and then the Format Instrument window comes up that allows you to choose data series or different data sources, symbols, resolutions, and so forth. So there are several different ways that Alex referenced the function key F5, and so there are usually different ways that you can do the exact same thing like that in multi-charts.
Yes, of course. I simply use that every day, so that's
right. I understand. Now, the second question is somewhat different, Alex, and I'd like for you to address this one because I think this is the more probably common question that other people are thinking that are attending.
Mm-hmm.
How would you rank the various chart types that you've shown for building into trend following and also counter-trend automatic strategies? Is one typically better than another?
No, I don't think so. Well, let me come back to this question after the presentation is ended, because I'm going now to speak about the last exotic chart type, and I will comment that I personally consider this one to be the most useful of them all.
Oh, okay. Okay, that'd be great. So if you don't come back to it, I'll remind you that we want to come back to this question.
Okay.
Okay, terrific.
So let me finish with Heiken Ashi to explain why we get realistic results much worse than the hypothetical. Again, it's more or less easy. That's because the long signal comes on this bar when we have a closing price greater than the open, and the closing price of this bar is somewhat like 1.308. But in reality, that in reality we cannot enter at this price. We cannot enter longer this price, absolutely, because at this moment the price is already 2 points worse. And of course this is going to happen every time, because if you recall how Heiken Ashi are constructed, you'll recall that neither of its reference points, neither closed, neither high, low, or open, correspond to these points in reality and regular bars. So that's why we have unrealistically good performance when doing backtest over Heiken Ashi, and have a poor performance when we do the backtest properly. And now, I explained all these points, and now the last exotic chart type that I will discuss is called line break. This is not actually very exotic, because it is not a synthetic bar type. It is more a special form of regular bars. And since that, it has at least one reference point which always comprises that of the original bar, and this is the closing price. This is very good for us, because at least we can expect that if we create a strategy that enters not with stop or limit orders but on the closing prices, then we may expect somewhat realistic. Let me explain how line break is built. Unlike Renko or point and figure, we now base our new blocks on the closing prices of regular bars. So we have this close that corresponds to the closing price of this block higher than the previous block high. Now we plot this block. So the opening price again corresponds to the closing price of the previous block, to that price. It doesn't make sense for example, backtesting, but the closing price of the block is always realistic. It coincides with the closing price of the bar on which this block was generated. And the same with all other blocks which continue to go to the upward direction. Now we have a reversal only in case we have a closing price of the regular bar lower than the low of the previous line break block. And this is basically all. So you see that we have a realistic, reliable closing prices, but abstract opening prices of these blocks. So really, unlike all previously discussed charts, the line break chart can be used for backtesting as is. And the other thing that we should always cater for is that we have to remember that we should generate our trading signals at the closing price of each bar, not on the opening price of the next. So in case we apply our same sample trading strategy to line break chart, the signal is generated on the previous bar, but the order from the multi-chart backtester point of view is executed on the opening price of the next bar, and we all remember that the opening price of a line break bar is something imaginary. So these entries simply cannot happen in real life. Of course, if we apply a strategy of this sort to line break charts, we again see a holy grail, the fourth one for this webinar. But in this case, we don't have to use multiple data streams. We don't have to adjust our trades with introducing artificial slippage values. We simply have to modify the strategy so that it generated entries not on the next bar, but on the closing price of this bar. I don't want to discuss the correctness of this test now because, of course, the closing price of the bar cannot match the opening price of the next one, and this is a very open and very difficult question if we really can execute our orders at the exact price that is the closing price of the bar. But in our case, that doesn't matter a lot because even if we don't have, if we trade a liquid instrument, for example, ES, and we don't have a fill at the exact price, at the exact closing of the bar, we may experience a slippage of, say, 1 tick, okay, 2 ticks. But we're talking about points here. So, as a sample, just like a proof of concept, this primitive strategy works well. And now, we have quite a different picture. And unfortunately, a more realistic picture is always looking far, far worse than the idealistic one. So instead of a period of flat trades, we now have a series of losses. And no wonder that finally we have the same ugly performance chart. So my own opinion is that these charts can be used both for discretionary and systematic trading. However, I'm only a systematic trader. I don't understand how to trade discretionary. But anyway, these charts can be used. The question is how to use them. And it is very important to understand that there is absolutely no edge inherent in them. Nothing. Although these charts are seldom used, this doesn't mean that there is something magical about them. No. All these charts are simply alternative way of data compression. So with regular bars, we have a data compression, for example, that works on equal time intervals, or volume intervals, or price intervals, and we have regular bars or volume bars or range bars correspondingly. And in this case, we try to filter out minor moves and leave only major ones. The question is how to determine this threshold, the box size in case of point of figure Renko, or the number of bars to break with line break charts. So the question is how to determine this threshold to obtain a useful picture. And for that, you still have to have some idea, some trading idea in your mind before you start to analyze any kind of charts, because any chart helps only finding proof of your concept. But you have to think about your trading idea before you start to use any exotic charts. So I was going to show that there is nothing impossible with multi-charts and nothing impossible if done right, and that backtesting is not something unrealistic all the time. On the quite opposite, it can and it should be realistic, and it should tell you about what you may expect from live trading of your trading strategy. But of course, everyone should perfectly, absolutely, 100% understand what he is doing. So this is basically all, and I thank you very much. And of course, I explained just a little bit of the procedures and methods I use every day developing trading systems and making research for the ideas of my clients. This is also part of my work. And I only hope I was able to demonstrate that the backtesting is more than important, and it should be done with absolute understanding of all the processes involved, and thus catering for the smallest chance of being inconsistent. And of course, there is much more to this exciting area of research, and I hope that I will continue this series of webinars. And in the meantime, you can check some information on the company website, or of course, you're welcome to ask me questions here or via email. So thank you.
Alex, we did have a question regarding your methodology, specifically for the test that you were talking about. And someone asked, are your results for ES using continuous contracts that are backward corrected, or are they for the front month contracts?
Believe me, it doesn't. This question doesn't make sense in this case, because we have an error so significant that regardless of which type of data we take into consideration for the samples that I presented here, that we will absolutely receive the same erroneous results. Moreover, it doesn't matter if we use ES or Euro or Gold or oil or any other instrument.
Okay. Now, this is a very interesting topic from my perspective, Alex, just so you understand. We get a lot of questions from new people looking at multi-charts that have simply heard about whatever the latest chart type or the latest style of trading may be. And they know nothing about the chart type, but they send us a question or they call us up and say, do you have Heiken Ashi? Or do you have, XYZ chart type? Because they've heard that there is some sort of holy grail associated with trading with this particular chart type. And what you're talking about, I think, is critically important for traders to understand, that you have to understand the, I don't want to say limitations, but you have to understand the properties that go into forming these exotic chart types. As you explained explicitly well with Heiken Ashi, there is nothing there in those 4 data points that match up with the open, high, low, close data points that we're used to seeing in typical bar charts.
Yes, Jeff, I can agree with you absolutely, because this applies not only to exotic chart types, but to trading and development of trading systems in general. You always have to understand what you're doing and what you're trying to exploit. For example, you cannot have a profitable strategy with an average trade value of 1 tick. This will be ruined immediately as soon as you try to trade it live, regardless of what chart type you will use. This was also the topic of my previous webinar. And so on, so on. So you always have to understand the reality of the market, the reality of trading, and clearly understand your position as a retail trader. I believe most of people attending this webinar are retail traders. So they don't have direct exchange access, they don't have commissions available only for exchange members, and so on, so on. So you have to first realize your position in this world and then start to develop anything.
Mm-hmm. Now, we've gotten a couple of questions that have come in while we were talking. Is it possible to test with data that has the ask price for buying and bid price for selling in order to be more realistic about a limit order being filled?
Yes, it is possible, and it takes a bit more time. But for a, let's say, easier and at the same time even more realistic idea, to get a more realistic idea about limit orders being filled, you can use simply a feature of the multi-choice backtester. If you open the backtesting properties in multi-choice, you will see a checkbox, something like execute limit orders only in case price goes, and then you enter the number of ticks. The price should go beyond the limit order so that it gets executed. Normally, with a liquid instrument like ES, it's enough to have this value set to 1. So if price actually was 1 tick below this limit order, then you may be more or less sure that your order would have been executed. Even if you have bid and ask data and you try to backtest a strategy for heavily traded, exchange-traded instrument like, again, the same ES, in fact, it doesn't tell you if your order would actually have been executed, because bid and ask information tells you nothing about your possible position in the queue at the same price. Believe me, this queue is very, very long. some people, like major players like Goldman Sachs or UBS, they occupy their seats in this queue very early in the morning at all the levels. So you have very poor chances to be the first in the queue. So, in other words, if your trading strategy is delivers good, profitable results with mostly from limit orders executed exactly at the historical price, then most likely the strategy won't work in real life.
Okay. Now let me ask another question that's slightly different. Can constant range bars be advantageous for always in the market type of strategies that trade on the open of the next bar?
Again, this depends on what you are going to exploit. I have a strategy, a very funny strategy, because it is, I call it semi-high frequency. This is absolutely not institutional high frequency strategy, but it trades somewhat like several hundred times a day, and it uses range bars, constant range bars. I wouldn't say that there is, again, any intrinsic advantage of range bars. But for me, it was simply easier to formalize the idea that I had in my mind using range bars than time-based bars. Of course, I could do that on time-based, but it simply would have taken more time, more formulas, more mathematics, and so on. But on range bars, it's just a bit easier. That's all. Again, and this applies to any chart type, absolutely.
Okay. So going back to the question that we had a little while ago, Alex, how would you rank the various chart types that you've shown?
Yes. I personally think that line break charts, in fact, can be useful, again, for detecting several trading ideas. I can give you a hint. With line breaks, it's relatively easy to identify pullbacks during a trading condition. Yes.
Okay. Okay.
So, in my opinion, they are more useful because they still have some information about time, at least some information. If you work with point and figure, you don't have any idea about time. If you work with Renko, you don't have any idea about time neither. And as the Heiken Ashi, honestly, I don't know how to use them. To my taste, it's just to creating brilliantly looking pictures. Nothing else.
It does seem as though it's a somewhat complicated chart type simply because every data point is based upon some algorithm.
Yes.
Whether it's an average or whether it's some form of creating a new data point rather than...
Yeah. As far as I can understand, this chart type was originally designed for discretionary traders who trade only according to their own vision that they receive from observing charts. So they look at charts and they think, okay, this is a trend. Most likely this is a trend. We can try to buy. If you read the reports of so-called analysts, you will see all the same every day because if price goes beyond this level, then it is quite possible that it goes for example, 10 points to the same direction, but at the same time, if it goes just 1 point above this direction, then it's very probably that it travels 20 points against this direction, and so on, so on, so on. It's impossible to trade. Have you ever tried to paper trade the analyst reports? It is impossible because they do not have any real trading. Not trading advice, but real trading command. No order can be generated based on analyst reports.
Right.
Just try and you will see that I'm correct.
My favorite early morning exercise when I traded on a daily basis was to read the different reports where they would give support and resistance points for the ES or for the E-mini or the S&P or whatever index you wanted to trade or stock you wanted to trade. And invariably, if you looked at 10 different opinions, you got 10 different support and resistance points. And it's truly, if you can think well enough of yourself to form an opinion, then there are that many opinions that are out there, it seems.
In fact, some of the analysts are very useful because about 3 years ago, I made quite some money trading opposite to the advices of one particular analyst. He published his reports in a local newspaper in Russian, and exactly at about 9 o'clock our time, that is 2 hours ahead of the London opening. And if he said that euro is going to fall, I bought euro. And if he said that euro is going to rise, I sold euro. I made about 400 pips in 3 months.
So this is not an algorithmic strategy that you can automate in some way.
Of course not. And it was just for fun, and unfortunately, I believe this analyst was fired. I was very sorry about that because he was fantastic.
Well, I think we've reached the end of our webinar now that we're bashing analysts, but I do appreciate the anecdote because it does give some insight into the amount of data that is out there for traders to process. And I appreciate the fact that you gave some insight that you did trade off of analyst reports, but you took the opposite position. Now, that's not a recommendation to do that with every analyst.
No, absolutely not.
Right. Okay. I do not see any other questions at this point, Alex, but I think that we have covered the ground that we set out to cover, and I certainly appreciate you sharing your knowledge with us today. I appreciate everyone attending today's webinar event. Any questions that you have for Alex, obviously may be directed. He's got his information or his contact information there on the screen at his website, edgesense.net, or by sending an email. Any questions regarding multi-charts, of course, may be directed to the multi-chart staff at 888-340-6572 or by visiting our website, which is www.multicharts.com. A brief reminder that multi-charts webinars are held on Tuesdays and Thursdays at 4:30 Eastern Time. We have recorded today's presentation, and as I said earlier, after checking it for technical issues, we will make the recording available at multicharts.webex.com. Just select View Event Recordings in the top right-hand corner of the page. And then, of course, as this event window closes, you will be redirected to the multi-charts website. Take the opportunity, if you've not already done so, to sign up for a 30-day free trial of multi-charts. And once again, Alex, thank you very much for staying up late and spending some time with us here. And we look forward to having you back again soon.
Thank you, Jeff, and thank you, everyone. Hope that the information that I tried to explain was at least somewhat useful for you all. So thank you, and have a good day.
Thank you very much.